Hello, hello. Welcome back, investors. I wanted to talk a little bit about one of my favorite types of investing, and this is mutual funds, and most specifically, index funds. In case you're not aware about what a mutual fund is, basically think about it this way. You could be buying a specific stock, let's say Apple stock, Facebook stock, Twitter stock, whatever, whichever stock, and then you have a portfolio that has just this single stock as part of its allocation. So when you do that, you have uh, you have the potential gains that a stock like Facebook could bring to you, but you also have the potential risk because if something goes bad with Facebook, then the majority, basically the whole of your investment will go down. And investing is all about gaining profit, but also mitigating risk while you do that. So you don't want to be gambling and basically potentially spending all your money in a specific investment that goes bad. And this is where index funds and mutual funds come into play and can help investors diversify. The reason for that is that a mutual fund, for example, is basically, think about it like a basket of investments. It's like a basket of stocks or bonds, for example. So instead of buying a specific company like Apple, you could potentially buy 100 companies that are part of the Nasdaq index, basically tech companies. So in this case, you would be buying the tech index fund, for example, a fund that actually tracks the performance of technology in the U.S. market. And so by doing that, you make sure that if one of the companies somehow goes astray and they start losing money, your investment does not get like super reduced because of that fact. Like it gets a little bit, you may get a little bit of a loss, but your other investments in the technology sector, in this case, would keep you afloat. So you'll get a little bit of a loss, but like a percentage of your total investment, just because you're investing in all sorts of companies. So, for example, let's picture the S&P 500, which is, in case you're not aware about it, it's the index that tracks performance of some of the 500 biggest companies in the U.S. And it's a weighted index, so not every part of these 500 companies has the same weight on the index. Like, for example, Apple, I believe, has the most, or did have the most at some point. I'm not sure. I have to check, but it's probably Apple still. And so there are like 500 companies that are corresponding and actually helping the index move, whether that's up or down. And so you could be buying this index fund and basically track your profits or losses based on that index. And this is a very good idea, generally speaking, just because it's considered, and it is, a pretty safe investment that's been, we have seen that over the years. Typically speaking, an index fund that tracks the 500 companies, the S&P, that I mentioned earlier, tends to gain about 8% per year if we're talking about a large period of time. In some years it could be even 20%, in some other years it could be a minus when there's a crash, for example, in the market or things are going wrong. But overall, since inception, I'd say it's about 8%. Now, the good thing about it is that if we buy index funds, we can basically just put all our money there and just let it grow. And we can use something like the rule of 72 to see how quickly it compounds. So, for example, if we get a 10% yield every year, using the rule of 72, which I have a separate video about, you can do like 72 divided by 10, which is the interest rate. Then you'll see that your investment will double every 7.2 years in this case. So you get a very healthy return every year, which is typically speaking a pretty safe return. I mean, there's not much risk involved with that. Now, the thing is, there are all sorts of different funds, and I myself have invested in different funds over the years. And I have invested in the S&P, in which I had some money for sure, and I also had high dividend yield funds, which dividends are definitely one of my best types of play. I kind of like everything. I like holding dividend stocks, dividend funds, growth stocks, growth funds. I like participating in all sorts of different plays personally. I love investing and I love different types of investing. It's just important to understand what's best for you, and depending on how much money you have to allocate, you may have to go a little bit more conservative rather than just going all out and spending all your money in potential growth plays. You don't want to do that when you can just make some specific amount of money every year and be safe with it, for example, mostly safe, for example, with dividends, for example. So in this video, I wanted to give you a way to use Vanguard. Vanguard is one of the very, very used brokers and one of the most important brokers in terms of index funds. And I'm not sponsored by them. I wish, I guess, but I'm not. I have just used them in the past, and they're pretty great, and they have very low fees. So almost nothing. It's like they have funds which have like an annual fee of 0.04, so which is very, very low. So I tended to like them a lot, and I still like them. And so this is why I'm using Vanguard. They have all sorts of different varieties of funds, and I kind of wanted to show you how you could track investments for your own sake, like potentially track some funds and see what you would like to invest in. And obviously, in the end, this is your own decision, and I don't solicit any specific purchases. I mean, I am not sponsored, or I don't have anything to gain from this. I just want to show you how to go about discovering potential investments that are going to be good for you. But in the end, you're going to be the judge of that, of course. So you can go to advisors.vanguard.com, basically, which is a very nice website that actually shows you different types of investments and funds. And so what I like to do is I go to investments and view all investments here. And over here, you basically can filter different Vanguard products. And this is, you can filter by dividend sectors, all sorts of things. But in my case, what I like to filter, and I think it's the most important thing basically, is use this inception here and basically filter from top to down. So you can actually see here that you want to see the funds that have been doing their best actually since their inception. Now, where the inception means basically when the funds were created, of course. So what matters as well is when they were created. So if it's like a 2-year fund, I wouldn't pay that much attention because they may have just gotten lucky. And in the past couple of years, a specific sector did well. And so you see these insane gains of like 25%, which is not typical. So I would avoid buying these funds just because they're doing well in the last couple of years. That doesn't mean much. It's not necessarily something that's going to continue. So I won't be paying attention to that. Maybe next 10 years from now, if they continue this kind of gains, which I doubt. So we want to see some more stable ones. And you see over here, it's also 2018. But now we go to something which is a little bit better here, for instance. And this is the Mid-Cap Growth Index Fund, Admiral shares. And whenever you see Admiral shares, it's just a fancy way of saying that you need to invest more in order to get this. So they have like a limit, a low limit, like you have to invest at least like $10,000, for example, in order to get this investing instrument. However, in most cases, they also have ETFs, and with ETFs, you can basically trade as much as you like for the most part. And so I wouldn't worry too much about it. But if you have the money to spend and you want to invest that much, it's generally speaking better to get Admiral shares because they have lower fees in Vanguard. Even if you don't get Admiral shares, the fees are still low. But if you can, why not? And so 2011 is not a bad inception date. It's like 10 years. So this is definitely better. It's longer term, and it's 16%, and this includes the Mid-Cap Growth Index Fund. And we could examine that, for example. Another one here is VU, which is S&P 500 ETF in this case. The most important difference between ETF and index funds, they're very similar. The idea is similar. The most important difference is that ETFs can actually be traded throughout the trading day. So they can be used as trading instruments. While mutual funds, you can only trade once at the end of the trading day. Bear that in mind. This means that they're less volatile, I suppose. But because they're tracking indices, I mean, they tend to be moving along the same lines for the most part. It's just that you cannot trade them when you're using funds instead of ETFs. So if you want to be an active trader, you generally use funds, and especially if you are a very, very active trader, you may use leveraged funds like 3x or 2x funds. Be careful when investing in these. You don't want to invest in 2x or 3x funds. I have a separate video about that because of the decay effect. You may want to watch that if you were willing to invest in those. Very, very dangerous. Be careful. Now, S&P 500 ETF. We checked. Yeah, the VU small cap growth index fund. Admiral says again. VSGAX. They always have a ticker symbol basically in order to be able for you to track them easily. Now, let's say that we wanted to examine a specific fund. You see here the inception dates and the overall. That's a yearly performance, by the way. It's pretty great. Like 15% is really, really, really great actually. When the usual like S&P 500 funds since inception is like 8%. But always bear in mind that this is the last 10 years. In the last 10 years, the market has been ripping. So if there is a correction, this will affect it tremendously. So be careful of that. Generally speaking, the more years since inception, the better. Like this, for example, is even better. But again, 2004 is not a very indicative date because we haven't had crashes in between. So that's important. So, the more crashes in between, the better. That's the thing, because like the average performance. But information technology is definitely a very interesting field to take a look at, especially in an economy that does well, of course. So yeah, information technology, mid-cap, consumer discretionary. So these are things like coffee, for example, companies like Starbucks, for instance, where it's discretionary. You don't really have to buy them to live, but you want to because they're awesome. So that's the idea behind that. So let's say, for example, take a look at a specific one. I'm going to do it at random here. So let's picture the small cap growth index fund Admiral shares. And we're seeing here that since inception, I think I held that at some point. So let's say we're interested in this one, the VSGAX. What we're going to do is we're going to copy that and we're going to go back to Vanguard. But this time we're going to go to the main Vanguard page, which is basically vanguard.com or investor.vanguard.com. And we're going to use this little search here button. And we're going to search for our instrument here. We're going to find it, and you immediately see that the minimum was like 3,000 in order to invest to this fund. You can open this one here, and this is a wealth of information here that you kind of need to know how to understand and what it means. So important to take a look at the expense ratio. So it's 0.7%. Which is basically 0.7% of your total investment. So if you're investing $10,000, it's going to be like $70 every end of the year, basically, just for investing in this specific instrument, which is, not much at all. So it's good to know. And the minimum investment is $3,000. And as you see, as I mentioned earlier, it's available as an ETF as well. So you can, instead of using this one, use the ETF and not have any specific minimum investments thresholds, basically. So you can see the risk potential here, which gives you a 5, which means that more risk, more reward, basically. And you would expect that just because this is a small cap growth index fund, which means that this consists of growth companies that want to grow. They're not established companies. They are companies that are actually not paying out dividends for the most part, but instead they're using their funds to grow as much as possible. So typically speaking, there is two types of investments: growth investments and value investments. So in this case, you would be buying a fund that has more risk just because it consists of companies that want to grow instead of companies that want to distribute dividends back to shareholders. And you can kind of see a portfolio composition here, and you kind of want it to be kind of diversified as much as possible. It will never be like super diversified to everything and exact. Some specific some specific sectors are going to be having more of a weight, which makes sense. I mean, not everything is going to be like completely balanced. The selection changes, and you can see this the largest holdings here, the 10 largest holdings at the moment. I'm pretty sure most of these companies you may not even be aware of, just because again they're growth companies. So it wouldn't be weird if you didn't know about those companies. And then the other important thing is the hypothetical growth of $10,000 over the years. So you will see here that if you had $10,000 invested in 11, like 10 years ago, today this 10,000 would be 40,000 almost, which is absolutely insane, right? Isn't it? Like in 10 years you would have quadrupled your money. Now this gives you an idea of how the fund is doing. However, you have to bear in mind that this is historical data. It doesn't mean that this will continue over the years. And as you see, from 2020 to 2021, there has been almost a stagnation here. So this happens. This is very, very normal. But it's the best thing that you have, because what else are you gonna be judging something from? If it's not cyclical in nature, how else are you gonna judge an investment? Like a cyclical investment is an investment that changes, like oil, for example. There are periods where oil goes down and goes up, depending on what happens in the globe. But for the most part, other types of investing, like investing in tech companies, for example, or consumer discretionary, as I mentioned earlier, is all about where the overall economy is heading towards. And if the economy is doing well, they tend to be doing well as well, just because it's like normal life. People are living, are buying stuff, so things are moving on normally. Now, if things go bad, these investments could also go bad. Like if people don't have enough money, they may stop buying coffee outside and just drink it at home. It makes a lot of sense. But in a typical environment, in most years, I'd say, economies tend to be like normalized, so these kinds of investments tend to make money if we're not talking about recession periods for the most part. So small cap growth is something that I would definitely personally invest in, because I like this potential growth for companies. And hopefully this gives you an idea of how to actually analyze and decide on your own on whether that's a good investment for you. And you can even, delve a little bit deeper, for example, and see some more information here, for instance, like how much the fund has gained over 1 year, 3 years, 5 years, 10 years. You can look at all those things, including taxes and all that. And so, yeah, you can get a better view if you really want to, and you should, basically. And, whoops, was a mistake here. And you can also examine the portfolio here, which Vanguard uses a method which tells you the market capitalization of companies and correlates that with a style. So basically it tells you that this is a small market capitalization company, of course, and it aims to grow. So it's a growth small market capitalization company, basically, fund. That's what it aims to track. And it gives you some information about, the price to book ratio, return on equity, price to earnings ratio, so how profitable the companies are, things of that sort, how much they are earning compared to their, how much the price is comparing to their book price, to their assets, basically. So yeah, all this information you can use, but I'd say the inception gains are probably the most important thing. And we have discussed, as again, is a little bit of a breakdown here about the sectors and which specific companies this fund holds. Now, we could also examine another one. For instance, let's say one of the very known ones, the VU one, which is the S&P 500 ETF. So again, we go here, we search, we find VU. And when we're searching, if we press enter here, You will find some different ones. It will take us to VU because that's the one we searched for. And again, we can examine here a similar idea. This is a little bit of less risk, of course, because it consists of a lot of big companies, so the risk is not that high. It's large cap companies, a lot of them. Again, the sectors here, and we can also take a look at the price and performance, and see over here that since inception from 2010. This has been gaining 15.8% every year on average, which is absolutely awesome. And if that continues, that's pretty insane, I'd say. And portfolio management here, some more information. Again, that's a blend, of course, because it's S&P 500 and it is a blend. It's, I guess, mostly large cap, I guess, yes. But, it's a blend of value and growth, because some of the companies are value companies, some of the companies are growth companies. How would you describe Apple, for example? Is it a value company or a growth company? It's a combination right now. It does pay some dividends as well, but it's growing. So it's a combination. So that's the correct way to put it here. But it's large cap companies because that's what the S&P 500 is about. And as you see here, the holdings is like Microsoft, Apple, Alphabet, a lot of tech here, Amazon, Tesla, Meta, which is Facebook, Nvidia, Berkshire Hathaway, JP Morgan Chase, and a lot of other companies, United Health Group. And so you can get a very, very specific overview of what the company holdings are and their weight towards the fund. And again, the most important thing, as I mentioned earlier, is how much the fund makes per year over the years. And the expense ratio is very, very low, 0.3%, 0.03%, which is like $30 for every $10,000 every year. It's like very little. And so you can see the performance as well. So $10,000 in 2011 would make for $44,000, 0.5. For 10 years later, which is absolutely awesome. Quadruple your money and then some. So that would be pretty great. Again, that doesn't mean that this will continue. Inevitably, at some point, there will likely be some crash, so you have to be careful. So, but it gives you an idea of what has been going on. It's your decision to decide whether you're actually going to invest now, later, or at any point. Who knows? Like, it's totally your decision. So that was the video, and I kind of wanted to explain how you could use Vanguard, and I'm pretty sure you could do it with other companies like Fidelity as well, but I just happen to be more of a Vanguard fan myself, and I've used them in the past. They're pretty good. And so I wanted to just use the interface here to show you how to discover the way to discover basically mutual funds and index funds that can work for you and have low expense ratios so that you don't have to pay for holding them basically. Hopefully that helps you, because these kinds of indices and funds, holding them can be very beneficial, just again because, as I mentioned earlier, it's not very risky, and it's nice to be able to grow your money without having too much of a headache. Like you're not going to be thinking about a specific stock. Like if you bought Tesla, for example, you may be thinking, will it be doing well tomorrow? Will it go up? Will it go down? When you are holding an index fund, you don't care that much. You just let it grow over the years, and it basically works for you. So while I don't necessarily recommend that you only hold index funds, I personally don't. As I mentioned, I like holding a lot of different things, especially dividend stocks and growth stocks. I like a lot of different types of investments. It's still important to have at least some parts of your assets allocated in less riskier investments. So think about it as retirement accounts or accounts that you want them to grow without having to be concerned about them. And then you have your sort of like play money, like the ones that you use to buy specific stocks, individual stocks, or other types of investments, whatever you like. Like it could be REITs, I don't know. Dividend stocks, whatever, crypto. So just bear in mind that it's important to understand that there's different types of investments, and it's probably a good idea to at least have some, if not most, of your portfolio allocated in less riskier investments that will flourish over the years. So that was the video. Let me know in the comments below. Are you holding any index funds, mutual funds? Do you recommend them? Do you prefer holding individual stocks or dividend stocks, value stocks or growth stocks? What is your favorite type of investment? And if you like the video, just leave a like and maybe subscribe if you want to learn more about the videos that are upcoming. There's gonna be a lot of them. And just be around and let me know what you think about it. So thank you for watching, guys. Hopefully you learned something today, and I hope I helped you a little bit. Have a great weekend. Bye bye.